Hey, good morning, everyone.
Good morning, Professor.
Good morning,
Yeah,
Prof.
good morning. Hi, good morning, Angel. Good morning, Kazuki. Good morning, Leslyn. Good morning, Darlene. Good
Good
morning,
morning,
EA.
Professor.
Good morning, Leslie. Seems like everyone has frog in their throat this morning. Um, let's see. Today's the fourth day. Actually, it's like each day, it's like 1 week because each day it's like 3 hours. It's like 1 week, 1 week worth of lecture, and so today makes it fourth week. So uh, I think we are roughly just about there on schedule, or maybe slightly behind. But it always, it's always better to be on the safe side than be behind. So we need to speed up a little. We need to bring up the speed. Let me. What am I trying to do? Let me. Okay. Let me first check how many people. I noticed 9 people in the collaborate. So let me make sure I have a matching number of people or more. Okay, I have 10 people. Looks like 10 people in the in today's forum. So there's got to be 10 here as well, but I
Are
have
you
only.
including yourself?
Hmm?
Because it's
Oh,
it's nine
yeah.
students unless you're including yourself.
No, no, yeah. Excluding myself, there are 9, and excluding myself, there are 10 here. So I think we still need one more person. There's 11, but that's including myself. So there are 10 actually. So I'm hopefully one more person will join our collaborate session. Well, that's fine. We are almost. Let's pick it up from where we left off yesterday. So yesterday we were talking about the different classifications of interest rate, right? Borrowing versus lending rate, nominal interest rate versus real interest rate, and how um, why and how the real interest rate is important. And real interest rate, since real interest rate is nominal interest rate adjusted for inflation. Now, this is something that uh, younger people, I mean, people at your age are not used to. I mean, connecting the mathematical concepts with, everyday language. So let me, wow, it was that big? I, okay. Okay, so the idea is, uh, that's nominal interest rate, right? That's the notation for nominal interest rate. And this is the notation for real interest rate. And then inflation. So that means uh, real interest rate is nominal interest rate minus inflation. But again, in spoken language or in verbal language, we can also, they don't say, real interest rate is nominal interest rate minus inflation. They would just they would say, I mean, people generally don't mix up their math with language, but um, people with mathematical mind or numerate mind, people with algebraic mind would use math in their language, but that's not people in general. But if this is put into verbal language, it can be translated as, or it can be put as, real interest rate is nominal interest rate adjusted for inflation, right? That's how they put it into a verbal language. Uh, so you should be comfortable with both of them. I mean, your mind should be quickly, uh, your mind should be flexible so that it can quickly latch on any expression, whether whether I say real interest rate equals nominal interest rate minus inflation, or whether I say or real interest rate is nominal interest rate adjusted for inflation, means the same thing. That means you're making an adjustment to the nominal interest rate, isn't it right? Mhm. You're making an adjustment to nominal interest rate by as much as the inflation. And as the nominal, um, as the real interest rate goes down by inflation, right? That is a good news, right? That's a good news for the borrowers, especially when it is time to pay back. So if we can forecast inflation, yes, inflation can be forecasted, but forecast isn't always the real thing. Think about it. Forecast is an estimate, and the actual thing may um, differ from the forecast. But still, um, when we are forecasting the future, the best, uh, there's no other way. The best forecast is the uh, is when there is the geometric average of the past data, right? When there's a correlation between the data. But uh, if there is no correlation between the data points, then you can use this simple average. I mean, some random occurrence. If it is a random occurrence, like uh, the day-to-day change, the day-to-day change in stock prices are like random occurrences. There's um, uh, there are uh, there are economic or political events that can affect um, uh, the change in stock prices day to day. But those things, for example, um, okay, I'm sorry. This is uh, well, sorry about that. Sometimes, and it was even a suspicious call. Sometimes, but that makes it look like a legitimate. Wait a minute, where was I? Yeah. Uh, for example, sometimes there are events that can make us, they can allow us to predict, the future. Something like, yesterday. I mean, Federal Reserve, uh, Federal Reserve announced that they are going to start raising the interest rate from March. And with that news, the market dropped. The stock market dropped. Um, but that's something already predictable. I mean, we know that the Federal Reserve FOMC met. FOMC meets. Federal Open Market Committee meets. Like nine times a year, and the last meeting was I believe like the last meeting started on Monday. They when they meet for like 3 days. So even before FOMC meeting, the market was already I mean, It's not a shock. It's not a surprise. But still, if it is not a surprise, because even before this FOMC meeting, right, they were, it's been predicted since like, beginning of the fourth quarter, of last year, it's been expected and anticipated that the interest rate increase is due. And of course, tapering is also, they started to, taper since the fourth quarter. So it's not a surprise, but until the stupid thing is the market only as if, it's like react. I mean, it was expected. What's there to be surprised about? But market just, it's like this, over action or overreaction of the actors, right? It's like, everybody knew that this would happen, but suddenly like, why? What? I never knew. As if this kind of overaction, right? If the actors are acting like this, you can tell, it's either comedy, it's a comical, it's a comic factor, or that actor is really poor at acting. But still, although the market knew that there would be, this is, rate hike is, already expected, they, just reacted to that news, and the market dropped. And because that was like almost like a mannerism. It's almost like a mannerism. Everybody knew that, so it isn't necessarily a shock, but it acted as if it is a small shock. And then today the market regained again, because that's, the drop in the market yesterday was like a overreaction. I mean, because of these, it's called Federal Reserve guidance. Federal Reserve always, communicates their goal and their intent with the media, so that way, they would, minimize the panic in the market, or shock in the market. So some of these events are predicted. It's predictable, and there are some events that are unpredicted, right? But other than that, we can make a forecast. Other than that, the forecast comes pretty much, easily from the average of the past data, right? I sort of, digressed a little too much, but so the point is, we can forecast. What did I do? We can forecast future inflation, which is like the average of the past, 5 years or something. And we can forecast also, based on that, also everything else. But the point is, if I can forecast that nominal interest rate, but the nominal interest rate is already fixed. Why? Think about it. When you get a loan, the interest that you pay on the loan is fixed, right? I don't know if any one of you ever got a loan. Did anyone ever take out a loan? Did anyone ever take out a loan?
Auto loan.
Yeah, auto loan. And your interest rate is fixed, isn't that right?
Yeah.
And who was this? Kyle? Yeah, Kyle, yeah, I will give you a zero point 0.5 point for,
Is my audio
uh,
sounding okay today?
oh, now it sounds okay. It sounds okay. Okay, so today is the 6th, right? January 6th. Oh yeah, January 6th. Last year the Capitol Hill insurrection. Ah, Kyle. So I'm giving you zero point 0.5 points. Um, sorry about that noise. Where was I? Yeah, the interest when you take out a loan, the interest rate is fixed. It's supposed because um, it's the contract, right? Loan is a contract, and during the loan period, so during the term of the loan, you don't want the rate to go up. I mean, if the rate goes down, it's wonderful, but you don't want the rate to go up. I mean, if you have a 5-year loan, if your interest rate is 5%, you want it to be 5% through the term of the loan, right?
I have a question also.
Oh, hold on. Yeah, yeah. Um, but if this interest rate can go down, there's no reason you wouldn't welcome that. But the bank wouldn't want it, of course. The lender wouldn't want it, and the reason it is fixed is that in case the market rate, the going rate in the market goes up, you will be protected. I mean, for example, think about it. If the interest rate is uh, not fixed, if it is not fixed, it's called, floating rate or flexible rate. If it is floating rate or flexible rate, the borrower is not protected. If the rate goes up, suddenly, your rate goes up too. Oh, then, nobody wants that. That's why you lock into uh, an interest rate, a fixed interest rate during. But sometimes some loans have flexible rate. In that's what happened. That's what caused the subprime mortgage crisis back in 2007. Yeah, was it Kyle? You had a question?
Yeah, I was thinking in terms of like financing the loan in particular. Would it be possible? The interest rate? Can you say the interest rate is fixed? But would it be possible to get a new interest rate when you refinance or like reappraise a property?
Yeah, 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 yeah. Refinance is basically, um, yeah. Uh, you can lower the interest rate by refinancing. Okay, but also then you would have to have a good credit score. I mean, if your credit score has improved, then there's a good chance you can refinance. Refinancing is, you may hear the term refinancing a lot. It's simply switching the lender, switching the bank,
Oh,
right? It's
um,
but
um,
I'm going to talk about that later because we don't have much time to we got to cover what we have to cover. So think about it. You borrowed money at a fixed rate, and inflation is can be predicted. I mean, although it may not be forecast is not exactly the actual inflation, because actual inflation can only be found after the year is over. Think about it. 2022 inflation for 2022 actual inflation for 2022 cannot be known until 2022 is over. Right now, we only have a forecast. There will be a difference between forecast and the actual data, but still, at this point, the best the best recourse we have is the forecast. And then if your nominal interest rate is 5%, And if the predicted inflation for this year is 3%, your effective interest rate will be 2%. That still is a good news for you because, um, by the time, for example, 1 year later, you will have to pay back. Then definitely, by then, whatever you pay back is worth less in real terms, right? In real terms. Okay. So, and then we were talking about the compounding and compound interest rate and simple interest rate. We already know a lot about compound interest rate. And the simple interest rate is used only in the money market. And I told you in financial market, long-term financial market is called capital market. Long-term means, longer than 1 year, right? Maturity longer than 1 year. Short-term means maturity under 1 year. And short-term financial market is called money market. And in money market, it's, simple interest rate is what they use in money market. So simple interest rate, there's no compounding. At this point, I will just tell you, there's no compounding. That's why it's called simple interest rate. So obviously, simple interest rate in the future value of the simple interest rate would be much lower, will be lower than compound interest rate. And of course, I can give you a mathematical comparison, but then you remember yesterday, I gave you future value 2 at the end of year 2 of 10K at 10% interest rate, 1.1 raised to 2. So it comes to 12.1K. That's compounding. But if it is simple, by simple interest rate, this is by compounding, then it's like it's only 120. 12, because it's like right. Of course, the reality is because it's what is this? Because that's just R times 2, right? 10% interest rate for 2 years. So then, it's not difficult to tell. It's going to be just, 12K. Now, the difference may not be a big deal. It's only $100 difference, but think about it. If we extend it for like 10 years, there will be a huge difference. There will be a huge difference, really, over 10 years. And then, of course, in reality, it's not going to be like this because think about it. 2 years, you don't have 2 years. In the context where the simple interest rate is used, you don't have timeline beyond 1 year. So you don't have anything like this. It's usually, for 30 days, for 60 days, 90 days, so it's for a very short, time period. You don't even have this. Now, so that wraps up our discussion about simple interest rate versus compound interest rate. And we all understand that the if you are borrowing, right? If you are borrowing, your rate depends on your credit score, right? And the higher the credit score, the lower the default risk. So your interest rate will go down, right? Because you're a low risk. All the lenders welcome you. And if a particular lender doesn't give you a good rate, then you can always take your business somewhere else. Other lenders will be happy to accommodate you, right? Now then, think about it. And the whole reason that we are talking about the interest rate is because interest rate is the bottom line of all return on investment, because it's the safest, in other words, riskless return on your money, or riskless return on investment. But then interest rate, who sets the interest rate? Actually, you might think each bank can set their own interest rate. Yeah, they can set their own interest rate, but there's a benchmark rate, and as I said, banking is a very competitive industry. So one bank's interest rate cannot differ significantly from another bank because it's very competitive. Although they can set their own rate, the rate differential between one bank from one bank to another would be very minuscule. And then they are all based on Fed funds rate. Okay, Fed funds rate stands for Federal Funds Market Rate. Federal Funds Market Rate. And then who sets the Fed funds rate? It's the Federal Reserve. Federal Reserve. But then this can be.
Is it the Federal Open Market Committee, Professor?
Yes, the Federal Open Market Committee. Yes. But then here's the thing. And who said that? Who said that? Federal Open Market Committee. Who said that?
Leslie.
Leslin. Okay. Leslin. Okay, Leslin. I'm gonna give you 0.5 for that. But this can cause a misunderstanding. This can cause a misunderstanding. It sounds like when I say Federal Reserve can set the Fed funds rate, that makes it sound like you may get the impression that Federal Reserve dictates, right? Dictates the Fed funds rate, as if they are issuing an edict or decree, as if they're putting out a decree that let the rate be 2% from tomorrow. No, not at all. Not at all. Not at all. Never. Absolutely not. Why?
So exactly who are the interest rates determined by?
Oh, well, as I said, Federal Reserve sets the Fed funds rate, but it's not by decree. What the Federal Reserve does is just setting the target for Fed funds rate. Okay, target. And the target and the actual market rate are two different things, right? Why? First of all, federal funds market is not the government. Market is an exchange. Exchange means where the actors or the agents come into play. Isn't that right? So federal funds market, because the name is federal, it sounds like it's part of Federal Reserve. No, it's not part of Federal Reserve. Just because the name has federal, Federal Union, does it have anything to do with Federal Reserve? No. I mean, you can have a name federal because the federal funds market is an exchange, a marketplace for the commercial banks. Okay, so in other words, it's a marketplace, it's an exchange where the commercial banks borrow from and lend to each other, right? So only the commercial banks are the members of Fed funds market. So it's exactly the name, as the name says, it's a federal funds market. It's where the commercial banks borrow funds from and lend funds to each other. So it's not part of the Federal Reserve System. Okay? But so then think about it. If it is an exchange, then there must be this Fed funds rate will be determined by demand and supply, demand for and supply of funds in that federal funds market. And it's just called federal funds market because within the United States, all commercial banks federally get together, right? Within this federation of the US states or banking system. So it's a completely private market. And Federal Reserve, for that matter, Federal Reserve itself is not a government agency. It's also a consortium of private banks, actually. So think about it. If there is a market, then there is always, there will be transactions. Transactions means in this case, lending and borrowing between commercial banks. But then why? So actual rate will be determined by demand and supply of the available funds in this market. That available funds is called federal funds, right? Because commercial banks also need to borrow money from each other. Sometimes, why? Because there can be some at the end of the day when the bank closes, all the banks must balance their book, and sometimes there can be some discrepancy due to some uncleared still incoming transaction, some transactions that are not complete, that are not complete yet or not completed yet. Because of these, the when the bank closes at the end of the day, the book is not fully balanced. Some discrepancy. There can be some, and if there's a discrepancy or you have shortage, or you have a shortage of funds, then you need to borrow this overnight. But next day, everything will clear up. The funds that were supposed to come in will come in, and the whatever the checks that must be cleared will be cleared, and so the next day everything will be okay. So all they need to do is just borrow overnight, just to balance their book. And then there are banks that have some surplus. There are banks that have shortage. There are banks that have surplus. The banks that have surplus can lend overnight, right? So think about it. So the actual Fed funds market rate will be determined by the demand and supply in the market. But the Federal Reserve sets the target for that. And how they then, if Federal Reserve cannot enforce that target to the commercial banks, then they cannot enforce it because it's a market economy. I mean, if you don't have to borrow, you don't want to borrow. If you don't want to lend, you don't have to. You cannot make, just because you are the Federal Reserve, you cannot make the commercial banks to lend and borrow just to make the Fed funds rate meet the target rate, right? But then through how do they? Then the point is, what's the point of setting the target if the well, the the goal of the Federal Reserve, the point of the Federal Reserve setting the target is to work through the market mechanism, so that the commercial banks, the Fed funds market rate by the commercial banks would come close to the target rate. Okay, this is so there's a lot of mechanism behind this, but they just simply say, they simplify it as Federal Reserve sets the target, Federal Reserve sets the Fed funds rate, and this can cause misunderstanding, and there's still a lot of misunderstanding about the monetary policy, because one very gross misunderstanding is when they increase money supply, they think they are printing money actually. No, they don't print money. They don't print physical fiat money to increase money supply. But it's only a metaphor. But some political idiots just only use that metaphor to fool the people, as if it's a metaphor. It's only a metaphor, but they are saying, Fed is printing money by tons, and it's gonna inundate our economy. It's gonna inundate our economy in inflation, blah blah blah. When the Fed increases money supply, yes, there is always room for inflation. There is always, it's gonna cause some inflation, but they don't really print money. But some people use rhetoric like this, and they are usually, politicians, or the think tank on the, think tank for a particular partisan think tank, partisan politics, and they use these rhetorics to inflame the political debate, and to incite the public. I mean, Republican think tank or Republican politicians will always use these, stupid metaphors, rhetorics, to inflame the Republican supporters. It's partisan politics. They're always saying, Obama is trying to, and Biden is, tearing down the southern border. So, the Mexicans are coming over, without any. I mean, though that's not true, but they are using those rhetorics, political rhetorics, to inflame the Trump supporters, so that they would go against, they would, incite insurrection, like, last year, January 6th. But, because of this, and usually, not very intelligent people are easily, a metaphor is a figurative speech. And by these figurative speeches, some people who are engulfed in tribalism, you should understand what I'm saying, white supremacist, tribal. They are very tribalism, Trumpsters, Proud Boys or whatever. They get inflamed by this rhetoric, political rhetoric, right? So once again, as I said, when Federal Reserve changes the Fed funds rate, it's not the actual market rate, and they can only set the goal. And through the market mechanism, we are living in a market economy. Nobody can, or no central authority can dictate, right, the price. Think about it. So what the Federal Reserve does, once again, set the target rate, and they work through the market mechanism to bring the actual market rate close to the target rate. That's what it is. So looking at the Fed funds rate trend, this material is my production back in 2018. So I think 2000, yeah. So 2019, because I think it includes the December of 2018. This was my production in 2019. So since 2019, it hasn't been updated, but we know what happened since then. Since the what is 2000? What happened in 2008? Does anyone know what happened in 2008? What was a major economic event that happened in 2008?
The recession.
Oh yeah. And who said that?
Leslin.
Okay. Leslin, you got another 0.5. But what caused that recession? What caused the recession in 2008?
The housing
Anyone?
market.
Did this start
Yes, this market
crash?
The collapse of the housing market.
Oh, okay. So let's clear this up. Someone said housing market. Someone said, but someone said another
Stock
person
market.
said stock market. Who said stock market?
Darlene.
Okay. Darlene, I'll give you 0.5. And who said housing market? Who said? Someone said housing market, right?
Yeah, I did.
Leslin and someone else?
Young.
Oh yeah, okay. But you are right. But I cannot give you a point for that, because to make distinction, the housing market crash happened in actually 2007, which caused the financial market crash in 2008. So yeah, they are related. Subprime mortgage crisis caused the financial market crash, but in 2008 it was financial market crash.
But can I add something? You remember what you were saying? The deregulations with the bank. Did we have a deregulation in the financial industry in 2008 or something like that?
No. Before 2008, the financial market deregulation happened actually in like 1999. And
okay,
because of the deregulation of the financial market, it was 98 or 9. Now I believe 98. So what they did, and who asked this question?
Leslin.
Who asked this? Huh? Leslin?
Yes, Professor.
Leslin? Okay, Leslin. So I'm giving you 0.5 for that question, because that question has a very valid point. Because until 1998, there was a separation between investment banking and commercial banking, which was, set forth by the law called Glass-Steagall Act. And Glass-Steagall Act was actually in 1930s. I don't know if it was 1938 or 1932, but Glass-Steagall Act was legislated in the 30s following the Great Depression, which was started by the great stock market crash of 1929. And it was all because there was in 1920s there was no distinction between investment banking and commercial banking. So through 1930s, at least three things happened in 1930s to regulate the financial market. One was Glass-Steagall Act. The other one is FDIC. The other one was reserve requirement. But but then in 1998, Glass-Steagall Act was lifted. It was so they deregulated financial market, and 10 years after that, deregulation of the financial market, then another market crash, happened. Another, a massive market crash, equivalent to only second to the 1929 stock market crash, broke out. So that's and who wanted to lift Glass-Steagall Act? Mainly Republicans at the time. Of course, law cannot pass without the consensus of the both parties, right? Either it was majority vote or not. I mean, obviously, if the Republicans were controlling majority of of the Congress and a Senate, they can always pass the law. But I don't remember exactly what was the composition of the what was the political composition of the Congress at the time. I don't remember, but even some Democrats voted for it. So then, obviously, why? Because obviously, and the Republicans are always, bribed by the lobbyists from the Wall Street and the large corporations. In other words, Republicans do not. Republicans are party for the wealthy, big corporations, and Wall Street, and they are constantly lobbied by. So they are, they take money from the, and of course, both parties, they are both, the lobbyists of the wealthy, 1%, and the Wall Street, wealthy 2%. The lobbyists are not lobbying only the Republicans, they are lobbying also the Democrats, and some Democrats get dirty too. And I would say Republicans are all 100% dirty, because they represent the interest of the 1%. I mean, if I can call that dirty, that's dirty, because the politics, corrupted by money, the interest, right? And the politics, and the stupid thing was, back in 1999, it was Bill Clinton was the president, and Bill Clinton served 2 terms, Democrat president, but he still signed that. Of course, he can veto it. He can veto it as the president. He could veto it. But he cannot stand alone from his party. I mean, it's politics is all about deal making. There must have been you scratch my back and I'll scratch yours type of deal, right? But then 10 years after lifting Glass-Steagall Act, so I'm not going to go into that, because this is another side, and this class is not about political economy. But anyway, after financial crisis, then they set the the target range. Federal Reserve set the target rate between 0 and 0.25. So that's why they say it's free money. Free money. If it is 0%, you're borrowing at 0%. That's free money. Isn't it right? And why a range? Why a range? Not why not a specific number? Why a range? Because, as I said, it's the target range. Because actual rate, as long as the actual rate falls within this target, then they can. It's like this, how they. I don't know if you ever saw the war movies, but if you see the war movies, there's an air raid, right? Bombing of Berlin or bombing of London, and then there are bombers flying over, and there are flags. They shoot. And how do they shoot those flags? What that means. The anti air raid. What do you call that? Anti-air cannons. It's going to be difficult to really hit one bomber, or a particular bomber, by one round. But they fire like a net, like throwing a fish net. Aerial, they fire the flags into a particular area in the trajectory of those bombers. So, in other words, somehow some bombers will get hit, right? So also, because they are trying to bring the actual market rate close to the target rate, target always has a range. Okay, it's a range. And then, see, this is how it behaved back in, this is January 2006, right? So until 2005, Fed funds rate was like 4.25. And then even prior to that, actually throughout what happened in 2005, they're not showing 2005, but in January of 2005, the Fed funds rate was almost like 1.25. 1.25, something like 1.25. So that means what? Over just 1 year, they hiked up, they hiked up the Fed funds rate by 4%. And yeah, if I remember correctly, was it 1.25 or 1.25, I believe, 3%. And considering then look at January of 2007, 5.25. So just over 2 years, they raised it by about 5%, which is a drastic increase. Drastic increase. And then it leveled off at 520, and then 2009. From January 2008, it started to drop. 2009, 0.25. It was held at that level until January 2016, and then went up to 2005. And then, by December of 2000. So think about it. The recession bottomed out around 2010, but it just bottomed out. It doesn't mean the economy fully recovered. It doesn't mean the economy fully recovered. It took almost like 10 years for the economy to fully recover. So by 2018, there was even a talk of raising the interest rate to by December it was like 2.5, and then they were all I remember the Christmas of 2018 at a family gathering. My relatives were asking me, actually my not my direct relatives, but my wife's side relatives were asking me, because they were all investing stock market, what's going to happen, will the interest rate go up, because I'm the economist there. So there was actually, scare, recession scare, because when interest rate goes up, the money supply will go down. There will be some, even minor recession, minor, but then, since then, what happened? 2019, there was recession was averted. There was no recession, and I will explain that to you later why that we could avert recession. And then the economy was doing well, and then 2020, the pandemic hit. There was brief recession, brief, right? During the pandemic, we didn't really have a full-fledged recession, brief recession, and then thanks to the stimulus package, actually during the pandemic, what happened? Consumer spending actually really increased. Everyone was buying all online, Amazon, um, uh, and
I have a
because
question.
yeah.
During the pandemic, was there a chance or were we close for a recession to happen?
Briefly, as I said, early at the early stage of the pandemic, like um, uh, like second quarter of 2020, we were experiencing a brief recession, or rather, slowdown in the economy. But then we never had any big recession other than the second quarter of 2020, right? Actually, think about it. During the pandemic, unemployment is at the bottom. Unemployment is at the lowest, and there are even, every month, have you heard? Uh, Last year, it's called, year of big resignation. People quit jobs in droves. How can you quit jobs if it is recession? And there's a shortage of hiring. I mean, shortage to fill the hiring, because people quit. And every November, October, September, October, November, the number of people that quit were like 4 million, in the order of 4 million. In November, 4.5 million. In October, 4.4 million, 4.2 million. September, 4.5 million. Look, it's called, and because there are plenty of job openings, right? People who say, economy is bad have no touch with the reality. They don't have no touch with the actual data. You cannot quit jobs if you're in recession. You get fired, not you don't quit. Not that, you understand? But people quit in droves, in massive numbers, because there were better job offers. So they switched people. And there are, why, in the first place, why there were job openings of 4 million? How did it open up? First of all, a lot of people took early retirement. A lot of people took early retirement. Why? During the pandemic, their asset values increased. During the pandemic, the stock market was very good. Why? Because the interest rate was very low. They put the interest rate, the Fed funds rate, back down to 0.25. And then so the stock market was very good. And if you have a retirement account, if you're near retirement age, your retirement account asset values were, exploded, almost, hefty, so they could take early retirement. And think about it. If these people, the senior executives, to retire, then who's going to fill this position? The middle executives. They either get promoted or they quit to take the job offer from other, companies, for senior executive positions. There is even wages are rising. That's why one of the reasons, the inflation has been going on or going up. So whoever can move to a better job offer moved up. They moved on to a better pay. So actually, the economy wasn't that bad during the pandemic. And because nobody stopped spending. I mean, the people who were hit hard were basically the people in the restaurant industry, right? The waiters, waitresses, servers, of course. Restaurant, hospitality industry was hit hard. The restaurant and hospitality industry was hit hard because nobody comes to eat. But then they order. So then and if you lost your job, then there was stimulus pay, and there was even a saying cases where people do not actively seek jobs because they live large on stimulus pay and unemployment benefit. There was even a case, well-documented case, where a single mom with just part-time job pre-pandemic was jobless after pandemic, but she was making more money without working because of stimulus pay and unemployment benefits. So these people never seek to go back to the old job, even if the job was a job. There are so many job openings. So then think about it. Consumption never went down. So the economy, hardly suffered. And it's all thanks to low interest rate. And then okay. I think I got so carried away. It's 107, but let's say consider that 105, and I think this is a good time to take a break because my throat, I have to give a break to my throat. So let's take a 10-minute break. So it's 108. So let's come back at 118. Okay, let's come back at 118. All righty. All right, we're back. We're back. Um, so uh, I would like to also let you know, remind you that collaborate session is only a reflection, right? The main lecture is uh, the lecture video that was already pre-assigned, right? And since you are expected to have studied the main lecture videos in advance, actually, I don't want to go over the same stuff uh, during the collaborate session, because then that's going to be just doubling up the same thing.
Professor, I have a question real quick.
Yeah.
I was reading on the assignments, the concept one you posted, but
Say
it
that
says
again.
that on the assignments, the thing that we're supposed to do.
Oh yeah, the concept check. Yeah.
Yeah, but it
Hmm.
says that's due on Friday the 27th. I just
That's
wanted
right.
to.
That means, uh, and I said this also yesterday, I believe. I gave you a 3-day window, 3-day window, and all you need to do is pick 2 hour consecutive 2 hour continuous 2 hour time slot that is best for you.
But the 27th is a Thursday, or is the 7th?
Seventh,
The
seventh.
Oh, okay, because
Today's
on
today's
the
sixth.
thing it
Today's
says.
Thursday. Today's Thursday. Today is January 6th. Tomorrow is January 7th, the Friday. So wasn't it the
Oh, okay.
instruction? Then the yeah.
No,
So
it's that in the
I
instructions it says Friday the 27th.
oh, maybe that was a typo. Just it's a typo.
Oh,
Okay,
okay, okay. I just
obviously,
wanted to make
maybe I
sure.
try to hit 07, but somehow my finger, uh, uh, I don't have butterfinger, but somehow it hit 2 instead of 0. Um,
That's fine. I just wanted to make sure that it was due tomorrow.
yeah, but as I said, get a head start, because if there is something, uh, if there is any emergency, like you lost internet connection, or I mean whatever happens, uh, if you alert me early on, I have response time. I can so always think about the logistics. If you do it at if you start at 11:30 uh, on the 7th, absolutely there's no time you can do it within 30 minutes. And but some people start at 11:30. I mean, during the regular semester, there are some really people that are senseless. They start at like 11:30, and they lose internet connection suddenly, and then they send me an email at 11:45, and in panic, Professor, I lost internet. It's all. Can you do something? There's nothing I can do, right? If you send me an email at 11:45 and I'm not on email watch at that time, right? So at least give yourself plenty of time. You have 2 hours, but better get started on the 6th at least, right? On the 6th. So if anything happens, then I will have. I don't check email every hour. I will check email tonight, and if there is some um, email from any one of you uh, about this emergency, then I can take action. And that will give you another two, at least, if I reset tonight or tomorrow morning, you'll still have, enough time to work on it tomorrow. Um, so that's it. Please get a head start. Yeah. So as I said, I don't want to double up the same thing. So during the collaborate session, I can, instead of repeating the same thing over, I can just talk about the things that I couldn't put into like 1 hour, 30-minute, 1 hour video or 30-minute videos. I mean, throughout the semester, we really don't have enough time to cover. I barely make it because um, uh, uh, I deliver the main lecture through the pre-recorded videos. So at least if you stick to the schedule, then you'll be done. You will cover everything by the end of the semester. But anyway, so I talked about prime rate yesterday. Now think about it. So what does and I said during the pandemic, the interest rate Fed funds rate was held at 0%. I mean, the target range was 0 to 0.25. So how does that keep the stock market afloat? I mean, think about it. First thing, you don't, when you buy stocks, generally you use your own money. You don't borrow money and buy stocks. It's like, think about it. Nobody is stupid enough to borrow money and gamble. I mean, there are some people who do that. They borrow money and gamble, and they are usually, addict, right? They're addicted to gamble. And those gambling addicts, there's a saying, the only way to cut themselves off from gambling habit is by cutting their wrists off. That's the only way. If they are addicted to gambling, and if they are addicted to gambling, they borrow money or even steal money. There's a saying, they steal from even their spouses, they steal from their relatives, they steal from their family, they do whatever to get, gambling money. Borrowing money to gamble is already crazy enough, but borrowing, because why? In gambling, the expected payoff is always, expected return is negative. Expected return is negative. Cannot be a positive, expected return. The difference between the stock market and gambling is in stock market, expected return is positive. I'm not saying expected return doesn't mean what you wish for. That's wishful thinking. Mathematically, expected means forecast, right? Projected return. So that's like average return is positive. In gambling, expected return is negative always. The average is negative. Think about it. If you go to Atlantic City or Las Vegas, you play slot machine, what are the chances of winning? I mean, you may win once, but you have to lose 99 times before you win once, right? Then if you average it out, it's always negative. It's negative. If the chances are 50-50, right? If the chances are 50-50, at least, then what? Expected return would be 0 if the chances are 50-50, right? But anyway, the point is, since stock market is a positive sum game, it's not a zero-sum game. Okay, you understand the difference between zero-sum game and positive sum game? Zero-sum game, gambling is exactly an example of zero-sum game, right? It sums to 0. What that means is if 4 people are playing cards, right, only one wins. Isn't that right? Only one wins. And the winner takes it all. So in other words, winner's prize, what's it called? Winner's Winner's prize. What's the other? Spoil. Winners in the war, winners spoil. What winner's prize is, winner's gain is other players' loss. Isn't it right? That's the nature of gambling. That's the nature of gambling. So the sum, it sums to zero. I mean, think about it. You sum the gain and losses, then it's zero, right? That's zero sum. But stock market isn't a zero sum game. Why? In stock market, it's a positive sum game because some people lose, some people win, but not all the people's loss equals winners' gains, right? In other words, winner's gain is partially coming from somebody's losses, but also winner's gain comes from also the gain in the underlying asset. Meaning, if you have Apple stock, the company Apple runs and they make profit. They sell, and if Apple sells more, if their revenue grows, and as their revenue grows, the profit grows as well. This profit is reflected in the stock price. Stock price goes up. If stock price goes up, and if you're Apple shareholder, if your gain in Apple stock doesn't come from somebody's loss. You understand? It comes from the growth of Apple. But in the short run, just how do you know Apple grew? How do you know Apple has grown? You have to wait 1 quarter to see their performance. You understand? The companies release their data. Companies release their data quarterly, right? Why do the companies release their data quarterly? It's because it's the accounting cycle, right? The businesses update their books. In other words, their financial statements on quarterly basis. Of course, you might wonder, don't they record their sale every day? Yes, of course they do. That's called journal. They do the bookkeeping daily, right? It's called journal. But then so they collect data every day and every week. Weekly and daily they collect data. Monthly they compile the data, but only for internal purposes. They don't release the data to the public every day. You understand? And when do they and why do they release the data to public quarterly? Because they have to report it to the
Shareholders.
No, actually, they only need to report their performance to the shareholders only annually. They are not required to do that quarterly. But the main reason their shareholders can get that performance record quarterly. But the main reason is they have to report it to the SEC, Securities Exchange Commission. Okay? Everyone heard about SEC, right? No? You know what?
No.
Yeah. SEC is the regulatory authority in investment banking. So they have to report to SEC, and that means the companies that are listed in the stock market, have this obligation because they are listed in the stock market, because they are that means they are selling their stocks to the public, and then they must release their data to the public. Of course, when they report to SEC, then this data becomes available to the public. That's how they release the data to the public. That also means a company that is not publicly traded, or there are companies that are not open to public. There are companies that are selling stocks in the stock market, and there are companies that are not allowed in the stock market yet. I mean, you have to go public. In other words, you must open up the ownership of the company to the public. That's what is meant by going public, IPO, initial public offering. So then to go public, you have to meet all these criteria. Not all the companies. It's not like everyone can list their company in the stock market. No. You have to meet the strict criteria. They don't accept anybody. They don't accept everybody to the stock market. It's not like that. So think about it. Every quarter, so at the end of the quarter, think about it. They compile their data for the quarter, and that can only happen when the quarter is over. So fourth quarter of 2021 was over as of December 31st. So the fourth quarter, fourth quarter 2021 data will be released when? January of this year. So sometime we're not even starting in the second week. Starting from the second week, it's going to be called earnings season. What does that mean? What does earnings season mean? They release earnings report or earnings data. Earnings means profit, right? They release earnings data starting from the first week of January. They compile the data from the previous quarter, and then from second quarter and from the second week of the first quarter, throughout the entire week of the first quarter, and the report comes out. Okay. So we can tell if Apple has grown when the data comes out. Okay. Or Tesla has grown when the data comes out. So think about it. In the first quarter of 2022, the fourth quarter of 2021 data comes out. And in the second quarter of 22, then the first quarter of 22 data comes out. Okay. And why did I come to this? What was I talking about? Oh yeah, a stock market is not a zero-sum game; it's positive-sum game. And because your gain, if you hold Apple stock, it's not because somebody lost, but because Apple has grown. But in the short run, like day to day, it's crazy. Day-to-day transactions are mainly zero-sum game, because if someone gained, it's because somebody lost, right? But again, the point is, knowing that the expected return from the stock market is positive, and there are something like you know what index fund is? You don't have to buy individual stock, but buy index fund or ETF. Index fund is like, a fund that invests on something like S&P 500 stock index. And look, all the stock market index, S&P 500, Dow Jones, NASDAQ, Russell 2000, they have all in the long run, it's upward trend. It was not, right? You understand? Let me show you. It's just very simple. Always. This is NASDAQ. NASDAQ dropped yesterday, except Dow Jones. Except Dow Jones, NASDAQ dropped yesterday. Dow Jones was the only one ended up with positive change, but this is S&P 500, NASDAQ. They all ended up in negative, but then today it's reversed. But let me just S&P 500. Let's take a look. Maximum. Weekly, monthly. Let's look. This was starting from, let's say, 2012. Of course, it was spend longer. Oh, monthly. Let's take a look at monthly. Even annual. Let's try. 1964 or 1963, 1961, whatever. Look, even starting from 2000s, there were times when there was spikes and dips and spikes, but look at the overall trend. Look at the overall trend. Look, if you bought S&P 500 index fund in 2000, let's say 2012 or 2015, let's say around 2012, it was around, okay, 1,500. And now, if you held it 8 years, I mean, let's just 5 years. Think about 5 years. 2015, where is 2015 here? So let's say it was about 2,000 level. Now it is 4,700 level. More than doubled, almost tripled. I mean, in net return, almost doubled in net return. So think about it. Interest rate has been like 0%. Fed funds rate has been like 0% since when? 2002, 2008. So if you cannot borrow at Fed funds rate, only commercial banks can borrow at Fed funds rate. But if you can borrow at Fed funds rate, it's free money. Now, even if you can borrow at prime rate, that's as cheap as it can get. And then if you borrowed at like, but think about it. If you can borrow at close to 0%, it's free money. And then put it into S&P 5 index fund. Over 5 years, you would have, doubled, right? By borrowing for free. Or even if you cannot borrow for free, you can borrow for cheap, right? If you can borrow at prime rate, you can borrow for 3%. That's very cheap. And then you can double. And if you, it's over 5 years. If you annualize it, still, if you annualize it, over 5 years, if it is 100% holding period, right? Over 5 year holding period, if it is 100%, at least annually, it will be somewhere around 20% return annually. Less than 20%, I would say, maybe 18 point something. But still, you only need to pay back like 3% annually. So if you get 20% return from the stock market, S&P index fund, 18% a year, you still get 15% for yourself after paying back 3%. This fuels the stock market. You understand why the when borrowing rate goes down, I mean, when you are borrowing, right? If this rate is low, it fuels the stock market. Not only fuels the stock market, and I talked about this. I brought up the stock market because of Great Resignation. Remember, a lot of people quit during the pandemic because people who are near their retirement age, they took early retirement because their asset values, their retirement account asset values were very high. And why? Thanks to the stock market, thanks to high valuation, because of the stock market boom and their asset values. And it's all because it's thanks to low interest rates. Okay, so that means when they raise interest rate, stock market will cool off. And that's why yesterday, stock market in general all went down. Okay, but I told you, it was almost like an overreaction because it wasn't unexpected at all. Right? That the Fed will raise the interest rate, it wasn't unexpected at all. And it's not only that. When interest rates are low, what happens? Borrowing goes up. This diagram is what it is. If interest rate goes down, borrowing goes up. Right? And if there is inflation, the more, because the real interest rate is much lower, even lower by the inflation. Borrowing goes up. And this borrowing, I'm not talking about personal borrowing. I'm talking about the businesses. Businesses borrow to grow their business. And when interest rate is low, it's good time to borrow because you can borrow for cheap and expand your business. And when businesses borrow, what they do is to borrow to increase their production capacity. Production capacity means what? Production capacity means their plant. Isn't that right? They increase their production capacity. If the plant is bigger, the production output level is bigger. With bigger output level, they will put out more goods. More goods translates into more sale. More sale means more revenue. More revenue means more profit. Make sense? So here, if interest rate goes down, borrowing goes up. And individuals, households increase borrowing. Why? If interest rate goes down, isn't this a good time to borrow mortgage? Can anyone tell me? If interest rate goes down, isn't this a good time to take out a mortgage loan?
Yes.
Yes, yes. Don't be too timid. Who said yes? That was very faint. Who said yes? Oh, yeah, okay. Yeah, when interest rate goes down, yeah. So three agents in macro economy: businesses, of course, there is government as well, but businesses, households, and individuals, all when rate goes down, increase borrowing. And borrowing, they're not borrowing to, there will be stupid people who will borrow to gamble. but those are addicts. But sensible people will not borrow just to have fun. Sensible people borrow to better their future, to invest in their future. For example, they borrow money to go to college, or they'll borrow money to go to graduate school. Get a degree that is useful. Not, get a. If you borrow money to go to college or go to graduate school, use it for a useful, very, useful degree that will give you a higher return on that investment. If you borrow money to study something like philosophy, I'm sorry for if you study philosophy, what's your job prospect? You can study philosophy, but then if you want to study philosophy, do not borrow money. Okay? If you can get a scholarship to study philosophy, then that's good. That's fine. But if you have to get a loan to study philosophy or something like sociology or history, or I'm not trying to put down those subjects, but I'm just stating the fact. The return on investment on those subjects is not very high, right? But if you get a loan but on a personal level, the borrowing increases. On a household level, the borrowing increases too, and on businesses, business level, borrowing goes up too. And when borrowing goes up too, right? Borrowing goes up, money supply goes up. This means money supply, right? I'm not going to, the main lecture explains the connection between, and then why, that's the symbol. In economics, that's the symbol for output, income or output. Income and output are two sides of the same coin. I will, I'm not going to get to that later. So this is, and then the opposite is true. When interest rate goes up, that discourages borrowing. It's not a good time to borrow when more burden. Then money supply goes down. That will cool off the economy. So when Federal Reserve has announced that they're going to raise interest rate in March, so I think this was the first FOMC meeting of the year, right? I always thought, I still, I feel like I'm still in the 2021. The first FOMC meeting, they decided to raise rate. Why is that? They want to cool off the economy. Why? Because of the rampant inflation. In 2021, we saw a significant rise in inflation. And no wonder. I mean, there was, first of all, there was, supply chain crunch. There was supply chain crunch, right? Everyone heard of supply chain crunch, right? Supply chain disruption, because of pandemic, the shipping from raw materials or industrial goods coming from overseas. The cargo ships, there were fewer cargo ships, and so it was squeezed. So then the price of things will go up because of lower supply. Supply, that's called then supply side shock. Supply side shock, and then wages went up. Wages went up, right? Why? Because there are job openings, but you can't fill those job openings. because people are not applying for those jobs. And those, but almost not because people are lazy. I've been telling you, unemployment rate went down to like 4.2%, which is the lowest possible. Natural rate of unemployment in the US has been around 4.5, but it was even below natural rate of unemployment. So that means everyone who is willing and able-bodied were working, right? And why not? Because these days, um, due to great resignation, there are job offers that are paying you higher, higher salary, higher position, middle management, middle management move up to upper management retired, lower management moved up to middle management. I mean, the only sector that hasn't seen any increase in wages is probably college professors. Right? But if you are working, you have a constantly, if you're job hunting, you will find better offers, and you can make a career move, to a better job, higher pay. So the wages wages went up. I think someone has Darlene, if you don't
I'm so
mind,
glad you
yeah.
got it. Which one do you
Huh?
like more? Because I wanted to get you a bigger bottle. Which one of the two perfumes you like more? Send me a picture so I can place an order for the large bottle.
Are you asking me, Darlene? Is that the question for me?
No, so sorry. I don't know why my laptop does that sometime. Unmute me. Sorry.
You were asking me about the perfume, my preference for perfume.
Sorry.
No problem, no problem. Um, where was I? So because of the wages and because of the supply, uh, uh, supply chain disruption, uh, nice cottage. Um, so that was the main reason, cause of inflation last year. So they are trying to raise interest rate to cool off the economy. Okay, and then so uh, this is a very important mechanism, if you think about it. This is how the Federal Reserve implement. This is the mechanism through which uh, uh, the Federal Reserve implements the uh, the monetary policy. Okay, so now let's think about the monetary policy. Uh, Federal Reserve has okay, so I think it's 1:58, and I think it's a good time to take a 10-minute break here. I've been, like, rage. I've been raging on. I mean, my throat has been raging on, and my heart has been pumping like, crazy. So I think this is a good time to take a 10-minute break. Um, to give some rest and to my throat. So let's take a 10-minute break and reconvene at 2:10. Okay, then we're gonna go into the monetary policy. Okay, all righty. All right, we're back. We're back. So we need to understand, how Federal Reserve um, affects the Fed funds rate. It's all related to the monetary policy, because raising or lowering, the Fed funds rate is part of the monetary policy. If you want to, and we understand. So, if you want to stimulate the economy, then you will have to lower the interest rate. To lower the interest rate, you will need to lower the Fed funds rate. But again, I said you don't do it by decree, right? You do it through the market mechanism. So that's where the open market operation comes into play. Or if you want to cool off the economy, you raise the interest rate. Again, Fed funds. Now there are actually Fed funds rate is only the short-term interest rate, because so to change the short-term interest rate, you have to address the Fed funds rate and 1 year Treasury bill, and the for long-term interest rate, you will need to address the 10-year Treasury note, or 10-year Treasury bond, a Treasury note. So that brings us to the discussion, some intro to the bond. Okay, because the Federal Reserve implements its monetary policy through open market operation. So we need to understand open market means basically what market? Bond market. And open means it's open. Open to whom? Open to anybody. Anybody means individual or institutional investors, individual investor, or institutional investor, and institutional investors are of course, basically the larger part of the financial market in terms of the capital they can mobilize, right? So individual or institutional, domestic or foreign, right? When we say foreigners in the financial market, they mean foreign investors, but they are not foreign investors in the U.S. market. I mean, can foreigners, when we say foreigner, it's not an individual foreigner, foreign individual. It means foreign institutional investors, foreign institutions, right? Foreign financial institutions. There are, I mean, every country, every financial market, as long as they are open economy, they have foreigners in the market. So in the bond market, and what's a bond? Bond is a borrowing. It's a debt instrument, standardized. The debt instrument, standardized, right? Standardized means there are certain features standardized that are standardized, such as first of all, face value of the bond is basically $1,000. 1,000. Okay, and the face value is not face value is the maturity value. It's not the price that you pay. Face value is the maturity value. At maturity, you receive $1,000. That means the price that you buy it for, or selling price is not 1,000. selling price is usually below 1,000 or slightly above 1,000. Okay, and also it depends on maturity. Face value, I told you, is maturity value, so that's what you get at maturity. Then maturity would be what? There can be 1-year bond, there can be 5-year bond, there can be 10-year bond, there can be 20-year bond, there can be 30-year bond. Usually maximum is 30 years. Maximum for maturity is 30 years.
I have a question.
Yeah.
Okay. So you remember I was saying that I asked a question a while back about maturity. So there's short-term maturity and long-term maturity, and
Yes, yes,
okay.
yes. Short term is, and I mentioned this, mentioned this earlier. Short term in finance and accounting, the line between short term and long term is already it's arbitrarily set at 1 year. So any maturity under 1 year is short term. Any maturity above 1 year is long term. Okay. So the names of the bond. So standardized. I said, bond is a debt instrument with standardized features. So the first standardized feature is the maturity value or the face value. It's also called par value. Par value of the bond is 1,000. Maturity value is 1,000. Face value 1,000. But that's not the price that you pay, right? Price that you pay will be most of the times lower or slightly higher than the par value. And another standardized feature is the maturity is like 1 year, 2 years, 5 years, 15, 10, 15, 20 years, 30 years. But then depending on the maturity, the names will be all different. Okay, here. So I classified it by maturity and the issuer. Who is the issuer? Who is the what is the maturity? So if the short term is less than 1 year, long term, actually long term is basically between 1 and 30 years. But in case of treasury, there is a maturity between 1 and 10 years and maturity between 10 and 30 years. And the names are different. Treasury is the US federal government. Federal government borrows. Treasury Department is the window for borrowing money, right? From the open market, from the bond market. So otherwise, there's corporate bond. So corporate for treasury, the maturity on the treasury security with maturity under 1 year is called a treasury bill, and the treasury with maturity between 1 and 10 years is called a treasury note. The treasury with the maturity between 10 and 30 years is called treasury bond. So the bond is actually the term reserved for long-term debt instrument. Okay, and then companies borrow from the bond market by selling bonds, and the maturity for short-term corporate bond for short-term is called commercial paper, and for long-term and for it's called bond, just long-term, and the long-term and very long-term this distinction is meaningless in corporate bond. It's just long-term. Because corporate bonds don't have this type of distinction in name. Corporate bonds can have 1 to 10 years or 10 to 30 years. They're just called corporate bond. They're just called bond. Only Treasury has names like distinction in names like Treasury note, Treasury bond. And for short term, the maturity can be maturity for the short term can be 1 month, 1 month, 3 months, 6 months, 1 year. Now think about it. Um, this maturity, 1 year or 10 years, 30 years, this maturity is when they were issued, when they were first issued, right? In other words, at time zero, at timeline, this is the timeline, time zero, time one, ten years. Oh, and then think about it. 1 year Treasury bill, when it was first issued, it has 1 year left to maturity, but as time goes on, maturity falls, right? So 1 year Treasury bill, 6 months later, will have only 6 months left. But there are also Treasury bills that were born with 6 months to maturity from the beginning. Then they are treated the same. In other words, the Treasury bill that was originally issued with 1 year maturity, after 6 months, it will have only 6 months left. Then the price of this Treasury security must be the same thing as Treasury bill, must be the same thing as Treasury bill that has 6 months, that was born with 6 months left. Okay. So the name changes. It was originally, let's say, there was a Treasury note with 10 years left when it was issued. But time passes and the maturity level goes down. So when it is 9 years have passed, so when it has less than 1 year left, then although it was originally issued as Treasury note, but with less than 1 year left, it's traded as Treasury bill. Okay, the same thing for Treasury bond. Now, collectively, they are called Treasury securities. Collectively, Treasury securities. Okay. Sometimes you need to use you need to call them collectively, because otherwise you'll have to repeat it 3 times, like Treasury bill, Treasury bond, Treasury note. You'll have to name them one by one. It's exhausting to call each one of them by name. So I'll just call them Treasury securities, collectively. Okay. Corporate bond. Now, so depending on the maturity and the issuer, there can be there's Treasury securities and corporate bond. There's also one that I didn't put there, municipal bond, also called muni bond, issued by municipal governments, like New York City government, New York State government, right? The muni bonds are all bonds. There's no short-term thing. Muni bonds all have like 30-year maturity. 30-year. They are, by default 30-year. They have 30-year maturities. But for now, we'll just think about Treasury and corporate bond. And it can be also classified by whether they pay interest or not. So there's an interest-bearing bond, which is called coupon bond. Coupon is the interest they pay on the bond, coupon bond. There's if they don't pay any interest, it's called zero coupon bond. And think about it. Does it? I told you. Bond is basically borrowing, a standardized debt instrument, right? Bond is, but then if it is borrowing by the federal government, borrowing by the corporations, borrowing by the municipal governments, for any borrowing, there should be interest. Isn't it right? There should be interest. If they borrow, they should pay interest. But so coupon bonds are paying interest. But zero coupon bonds don't pay any interest. Then you might wonder, if they don't pay any interest, why do they buy if it doesn't pay any interest? If they don't pay interest, they will have to sell at deep discount. Okay, they will have to sell at deep discount. Meaning, one good example of zero coupon bond is 30-year U.S. Treasury 30-year U.S. Treasury zero coupon bond. It's often called, commonly called U.S. savings bond. Have you ever heard about U.S. savings bond? Anyone? No? Yeah.
No.
No? Okay. U.S. 30-year U.S. Treasury zero coupon, or simply U.S. savings bond. Now that means they don't pay any interest, and 30 years is maturity, and the face value is, of course, the face value is 1,000. Then what does that mean? Is there if you want to buy this, do you what do you have to pay? Do you pay $1,000?
Less than $1,000.
Yeah, it has to be less than $1,000. It will be, who was that? Yang?
Yes. Yang.
Okay, so Yang, I'll give you 0.5 for that. Yeah, you'll have to be a very senseless person, or you'll have to be, in other words, just simply not a very smart person to pay $1,000 today to get exactly $1,000 back 30 years later. Who's going to do that? That's a dumb thing, right? Even if you get just over 30 years, there will be inflation. Over 30 years, then even if you get $1,000 back 30 years later, the purchasing power, because of inflation, the money will have already lost. 1,000 will have lost a lot of purchasing power. That won't be, so the only way this sells, so U.S. savings bond, let me tell you, straightforward, they sell for $500. They sell for 500, right? What does that mean? They sell for $500, right? Today, with 30 years left, they sell for $500. And 30 years later, you get 1,000. You redeem. They redeem. U.S. Treasury Department redeems the bond by paying you 1,000. And if they pay, so then what's your return? Your return is 100%, but this is 100% over 30-year holding period. 100% over 30-year holding period. So if you annualize it, it may not amount to much, but that's what how zero coupon bond works. Is because they don't pay any interest. Instead of paying interest, they sell at deep discount. Next, in case of interest-bearing bond, as they pay interest, but then I told you bonds sell below or above par value or mature face value. So interest-bearing bonds can sell below par value, or the selling price can be below par value. In other words, discount bond, right? If it is selling below par value, it's called discount bond. If it is selling above par value, it's called premium bond. Okay, so and the reason they are selling for above par value at premium or at discount, it all depends on whether the coupon rate is greater than the discount rate or less than discount rate. Discount rate being the prevailing market rate. So for this, we are out of time. So we're going to talk about this. We're going to continue with this tomorrow. And tomorrow is March, not March. Let me just, it wasn't 27. There was no, I just checked. The dates are all correct, right? The ROI concept check. Due date Friday the 7th, right? Not 27th, okay? And then there will be a second self-diagnostic test, which is called ROI practice and self-test. It will be available from 7th, tomorrow, right? And then due Sunday 9th. Okay, this announcement went out today because it's right, Thursday, posted on Thursday, January 6th, right? So please do it by all means. I mean, first concept check, ROI concept check, due tomorrow, but get started already, today, and then Sunday, the second diagnostic test is due. Okay. All right. Any questions so far? Any questions? Any questions? I don't think. Nobody's saying anything, so I will assume there are no questions. So, all right, then have a great afternoon, everyone. And I will see you guys tomorrow at 12 again. All right?
Thank you,
All right.
Professor. Have a good
All
one.
right, Randy. All right, Ian. Take care, darling. Take care, everyone. Take care,
Bye,
Leslyn.
Professor.
All right, take care. Take care,
Have a good day,
Malika.
Professor.
All right, take care, Angel, and yeah.
Bye,
Take care,
Professor.
everyone. All right, Kazuki, take care. All righty. I'll stop sharing, stop recording.